Hello, everybody. Welcome to this webinar that is titled Shop and Invest in REIT, brought to you by Bursa Malaysia and managed by our company LifeChamp. And in conjunction with the International Women's Day, we are organizing this session, Shop and Invest in REIT, for us to learn and how we can shop in the retail mall and evaluate opportunities to be a shareholder of the retail mall. Okay, today we are very excited to invite the head of investors relations of Sunway Group to share with us on this topic. So my name is Shen Chu. I'm the moderator for this session. And before we begin, allow me to briefly introduce the disclaimer, which is whatever we share in this session is only meant for educational purpose. In no way that we give any recommendation for you to buy or sell any listed securities that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. Is that okay? All right, cool. So allow me to call upon our speaker today. Today we are very honored to have invited the head of investor relations of Sunway Group, Miss Crystal Tay, to come and talk about this topic: shop and invest in real estate investment trust. Over to you, Crystal.
Thank you, Shane. Thank you. Let me share the screen. Hang on, yeah, let me share the screen. Are you able to see the screen?
Yes.
All right, great.
Yeah.
Okay. Good evening, ladies and gentlemen. Before I start, I would like to take this opportunity to thank Bursa Malaysia for inviting me today, as well as Shane for organizing the event today. As you can see here, and as introduced by Shane, the topic for today is shop and invest in REIT. This is in conjunction with the International Women's Day, and I would like to actually say happy International Women's Day to all women out there. I'm sure that in this platform today, I can't see, but I'm sure there are men as well. So likewise, have a good day and happy day to you. For this year's theme, it is Embrace Equity. And I find this very interesting because when I look at the tech, right, the theme this year, Embrace Equity, immediately I see is equity, and equity, I actually relate that to Bursa Malaysia. However, it doesn't really mean that in reality. So before I move on, maybe I will just take this opportunity to share very interesting concept of this International Women's Day's theme this year. When they talk about equity here, right, I think a lot of times and very often we hear about equality, gender bias, gender equality, which is so commonly heard. I'm not here to be a feminist today, but I thought it would be nice for us to also dig a little bit further in and try to understand what does this theme actually mean. So in this year's theme, it says that talking about why equal opportunities are no longer enough. And I actually do a Google search, not knowing what is the difference between equality and equity, and I've learned something new today. So what happens here, it says equality it means that all of us, every one of us, is given equal resources and equal opportunities. But in the sense of equity, what it means is that it recognizes that each individual could be different, and we may not be having the same leverage per se. As such, equity means we have to acknowledge the differences amongst one another, and at the same time providing the resources for them to be equal. So that's very interesting concept, and that actually leads me to the next thought that I have, which I think it may be right or may not be right. I think it may not be fully tested as I didn't do sufficient research to establish this fact, right? When we talk about equality or even equity, I personally suspect that maybe in Malaysia or even in the context of the world, investment is something that is still dominated, or if not, the ratio of investment, it will still skew more towards men instead of women. Maybe women like us do not invest sufficiently, or equity, if I may use the word, right, equity, as much as men. So I would like to take today's opportunity to share with you some of the women out there, why we women should also consider investing. And I actually found this extraction very nicely, so I won't reinvent the wheel. It's from the Aham Capital Asset Management, one of the publications, which also in conjunction of the Women's International Women's Day, which they talk about why investment is important for women. And they highlighted 5 very important and pertinent reasons. The first one is we need to build emergency fund, because in life sometimes, while life can be smooth sailing, but it can also be not smooth sailing at the times when it is least unexpected. So in this case, the advocation is that this is already not gender biased, whether men or women, we should be prepared for emergency funds for the worst of times, because there may be times where we could lose our job, or our business goes into downturn, as well as it could be as simple as illness that need us to fork out savings from our, money from our savings for that purpose, to last us for a period of time. Secondly, is to advise us to set goals for ourselves. So in this case, I think personal goal aside, or whatever career goals, it is also important to set goals for your financials, because in a very simple example, I think which most of us would go through is perhaps setting goals for example, education funds for our children. So that is already a very good example of why we should set a goal for our financials. And thirdly, plan and revisit our budget. So in this aspect, I think what is important for us is, whilst we plan our goals, set our financial goals, we will naturally also typically set the budget. But it's also good from time to time that we revisit the goals, revisits where it is, as well as the budget. Do we have to adjust the budget accordingly? Because sometimes in lives, we cannot assume that our income grows in a linear way, right? We have ups and downs. Sometimes we change jobs, etc. Or business has its ups and downs. So sometimes it is also very important for us to revisit our budget and goals, and also adjust them accordingly, so that it can last us through a longer period of time. Number 4 is learn in and learn. I think this is an interesting concept, because especially in the case of investment, right? I always encourage people that we should do homework, and we should make informed decision. We should not be just listening to rumors and speculate instead of investing. So when one speculate, you probably just listen to who says, and also you listen to rumors, and then you make your investment, your speculation decision. But in the case of real investment, I sincerely think that all of us should do homework, and also we make informed decision. And today, right, in today's world, we are very privileged, because we have so many platforms, just like this platform itself. We have the opportunity to learn from many subject matter experts, to listen to many different views, and also to learn new investments products, for example, which we never had those privilege in maybe 20 years ago. So this in today's context, we are all very exposed to a lot of opportunities to learn and equip ourselves better. Because I also believe that, like what Warren Buffett says, right? Do not invest in something that you don't understand. So that's why learn it and learn is also very crucial. And finally, invest for our future, because I think most of us, when we invest, we plan to save, and we save for our good old days, right? When we grow older, and how long it lasts us through our life expectancy, through our retirement, and also what sort of retirement that we would like to be enjoying, whether in a very comfortable material manner or in a very comfortable but in a very simple manner, because life sometimes can be very, very simple, and also because best things in life are actually free. So that said, even though free, I think that lasts us for a long, long time, because life expectancy has grown over the years, right? That's why we need to invest for our future. This page is, I would say it's just for fun. However, that is also to tie into today's concept and women. So as we know, and it is a public information, no secret that women likes to shop. I do not deny that fact. So here we talk about shopping, and I would like to bring these questions to you before we start our official presentation. Is should we shop and invest, or should we invest first and shop later? So I think as we go through this presentation, give yourselves this thought, and then maybe at the end of the presentation, you tell me your answer. Do you shop and invest, or you invest to shop? Okay. So moving on, okay, now we start the serious part and moving on to the serious part. In my presentation today, I would like to share with you on REIT investment. As much as REIT has been in existence in Malaysia since 2005, I think until today, people or general investors may still not be truly or fully understand how does a REIT work, and what does REIT do, or how does REIT generate return to investors? Or in our case, we are not called shareholders. The investors of REIT are called unit holders. So let me bring you through. For seasoned investors, please bear with me, because these few slides are going to be the basic of REIT, and I will take a bit of time explaining for the benefit of some of you who may be new to REIT investment. So essentially, a real estate investment trust, or most of the time, in short, we call it REIT. It is a collective investment scheme. And what does it mean? Essentially, it is very similar to your unit trust funds, which you invest through your through the unit trust agents or through the unit trust company. So they are in a similar format. It's a fund, it's a trust. That's why the shares that you invest in a REIT is known as units, and they're not known as shares. Which this trust that you invest into will invest in a pool of real estate properties, and these real estate properties are meant to be income generating, because the objective of this income generating assets is to distribute regular income distribution to unit holders. In this case, later I will go into the detail as well. So what a REIT does is, the REIT is supposed to invest into property which generate income, and this income will be paid to unit holders or investors as income distribution. In the context of REIT, it is known as distribution per unit, DPU, which in comparison to the usual listed PLC, they are called DPS, distribution per share, dividend per share. So in our case, it is called DPU. Okay, and how does a REIT work? Essentially, when you invest in a REIT, it provides you an indirect access to large real estate portfolio, meaning you are investing into iconic properties as well. For example, the KLCC Pavilion, in where I work, Sunway, you are investing into the Sunway Pyramid Retail Mall. So these are the assets which the REIT owns. And these assets are professionally managed by professionals at the REIT level, which they are called REIT manager. So they are the fund manager. And at the operation level, they are managed by the facilities managers, or the, depending on what terms you use, sometimes we call it asset managers. So they are all professionally managed and governed by regulators, being the stock exchange, Bursa Malaysia, and Securities Commission, as well as it is governed by the trust deed, which is the your article of association of a company. And the most attractive advantage of a REIT is that they are tax transparent or tax exempted. If you have seen REITs, most of the time we say REITs is a high dividend paying investment. And why why and how a REIT can be high dividend paying is because by regulation, the REIT has to distribute at least 90% of its income. So based on its profit, every year's profit, out of the distributable profit, they have to distribute at least 90%. And if the REIT distributes 90% and above, the REIT will be tax exempted, so they don't have a corporate tax. And with this 90% being distributed to the investors, investors, like for example, retail investors will be subjected to a 10% withholding tax. Okay, this is a structure of a REIT where we say it is highly governed is because when you invest in a REIT, it is professionally managed by the REIT manager and the property manager, and they own a pool of properties, and it is also governed by the trustee. In this structure, it is very safe in the sense the trustees' role is to ensure that they act in the best interest of unit holders, not in the best interest of the REIT, to ensure that the REIT is managed professionally and in compliance. So this is an advantage of investing in REIT because it is highly governed. Some of the REITs would have sponsor. Sponsor in layman term essentially is like your parent company. They will develop, they will incubate properties, and when these properties are ready and mature enough to be sold and to be injected into the REIT, so then the REIT will have a pool of ready assets that they can grow over time. That said, that doesn't stop the REIT to invest from other external parties as well. So in most cases, whether Malaysia or internationally, right, they do invest or acquire properties from their sponsor as well as from third parties. Okay, in this slides, just an illustration for you to visualize if you're a REIT investor, right? What do you get out of your investment in a REIT? Essentially, is if I invest in the units of REIT, then the REIT invests into properties. So they can invest into, depending on their mandate, so they can invest into, for example, retail, hotel, offices, industrial, and others. So this REIT will own and manage, and from these properties which they own and manage will generate income. In the case of, say, hotel, okay, maybe not hotel, in the case of retail malls and offices, where they get income is from rental. They rent it to their tenants pay them rental, and that's where they get their revenue. For other properties such as education, industrial, usually they go on a different structure. It is called master leases or long lease. So when they go into a master lease, long lease, they also rent it to the tenant, but they rent it for a long term, and then the tenant will pay them rental as well. And with all this rental in the portfolio that they earn, they will pay investors, or they will reward investors in the form of distribution income, meaning the DPU, which I mentioned just now. Most REIT, okay, I would say all REITs will distribute at least 90%. If not, some of them even distribute as high as 100% of their distributable income. And they distribute on a very regular basis. So it is very predictable, not that one quarter I distribute, the next quarter we don't need to distribute. They cannot. So what a REIT must do is that based on their mandate, they will distribute whether quarterly or semi-annually, and at least 90% will be paid out to investors. So this is where you get your very stable income, as well as you will get your relatively high dividend. Okay, then the next part is capital gain or loss. Just like any investment in the equity in the stock market, you will be subjected to equity price movement up and down. And this is where a REIT will also be the same. There will be price movement in the REIT that you invest. And most of the time, this price movement will be affected by factors such as whether the REIT grow their portfolio. That means they acquire more and more properties, just like individual, like you, right? When you buy residential property. Maybe when you have two, you start renting out one, and then as you buy more and more, then you will rent out more and more. Just like the case of a REIT, when they acquire more and more properties, they will have more and more rental, and that's where they grow, and their growth will be typically higher than your normal rental reversion if you acquire more properties. So this is where it will be reflected in the price movement, the share price. Of course, the losses can happen because of many other reasons, just like any other investment in equity. Last 2 years was a good example because of COVID. The pandemic has hit the revenue of the REIT because some REITs have to pay rental rebate to their tenants. Some REITs lost their tenants, so that naturally the loss of income or the lower income will also generate lower revenue to the REIT, right? That resulted in price movement to the negative side as well. So when you put these two together, that is the concept of total return. Yeah, so most of the time when investors talk about investing in REIT, the focus point is always on distribution, the DPU. But in reality, in fact, I would encourage you to also look beyond DPU, because the capital appreciation and depreciation, right, will have an impact, if not bigger impact than your DPU sometimes, which you will see in the slides later. And the total return will eventually be more important than just looking at the DPU or the dividend yield. Okay. Advantage or why should you invest in REITs? I think number one is definitely low barrier to entry, as opposed to you acquire a residential or a shop lot. That requires definitely much higher cost than investment in REITs. And this low barrier entry is also unique in the sense, with very little money, you can invest in high quality commercial properties in the country and even in the world. Imagine normal people, ordinary people like us, not many of us can afford to own a retail mall like KLCC Pavilion, Sunway Pyramid, or a hotel like Sunway Resort Hotel. So in this case, with your very little investment, you are technically a shareholder or owner of very high quality iconic properties in the country. Secondly, the regular income distribution is a highly predictable and sustainable investment for you, because like I mentioned just now, it is by regulation that the REIT need to distribute at least 90% of their income, whether it's quarterly or semi-annually. So when you invest in a REIT, the advantage or the certainty that you will get is that you will get dividend for sure. It's just that the quantum of it, the payout also, you will know whether it's 90%, 95% or 100%. Of course, the quantum of it, which is one that will not be certain, because that quantum of your dividend is dependent on the income of the REIT, and the income is also dependent on the performance of the REIT. For example, their rental reversion, their occupancy rates, and etc. So that's it. The certainty of your regularity of income stream is very certain. Thirdly is it is also a liquid proxy compared to your investment to, say, physical real estate, which is a lot more illiquid, because this one is a daily trading, which you can trade easily, or you can invest and dispose easily via the stock exchange. And like I mentioned, it is also professionally managed, as well as the requirement for REIT, because it's governed by Bursa and as well as Securities Commission. So the disclosure requirement is relatively higher in that respect. So you will see a lot of disclosure in the annual report or integrated report, as well as quarterly results as well, with details as to the property's performance and many other details. Yeah. So here I would like to share with you the landscape of REITs in Malaysia. How big is the REIT market? How is the performance? How has the performance been in the last couple of years? And what is the prospect of the REIT market as we are speaking today? In Malaysia, as we speak now, there are a total of 19 REITs. They are essentially split between specialized and diversified REITs. The specialized REITs are, they specialize in a particular subsector. And for example, in this page, you can see we have pure office REITs such as IGB Commercial REIT, Central REITs, Tower REIT, UOA REIT, industrial, very 100% industrial atrium REIT. There is also specialized healthcare REIT, our ACA, hospitality REIT being YTL, pure retail being IGB REIT, Hectare REIT, KIP REIT, and then on the diversified, there are more diversified ones such as Sunway REIT, CLMT, CapitaLand Mall Trust, and Al Salam. There are also some which are diversified but still pretty much focused or heavily skewed towards certain sectors, such as industrial focus will be Axis REIT, AME REIT, which was listed last year. Retail focus is Pavilion. Office focus with KLCC, M First, and also Amanah Raya. On here, this is a snapshot of the size of the M-REITs market in Malaysia. We call it M-REITs because Malaysian REITs industry. So in the M-REITs market, as you can see, it started back in 2005. Back then, the first REIT which was listed was Axis REIT, and it has grown. Actually, Axis REIT has grown very well, grown leap and bound to where you see today the market cap is 3.1 billion. They started with less than 500 million those days. And the market has grown steadily over the years to just before COVID in December 2019, the size of the market was close to 44 billion. And it shrunk a little bit during COVID. But we have also started to recover last year, and today it is around 41 billion ringgit. It's still not back to the pre-COVID level because of several reasons I will share with you later as well. In terms of the sizes of the REITs in Malaysia, you will see that the top five, if not, the top five are a lot more bigger. Actually, the market is quite dominated by the top five, and then subsequently, some of the smaller REITs are relatively small in the context of investability. But you can see that the largest REIT in the country is Stapled Group. It is actually Stapled REIT. It is KLCC, followed by IGB, Sunway REIT, as well as Pavilion and Axis. As for performance, this is the interesting part. A lot of people would ask, what should I expect when I invest in REIT, right? And if you look at this, I think this chart turns out very well in conjunction with International Women's Day. When I was plotting it, it looks like a Wonder Woman. Can you see the W there? It looks like a Wonder Woman. So joke aside, when we look at performance of REIT, typically, I would like to bring your attention to the red line. The red line is the distribution yield. Most investors would focus on the distribution yield, and it is actually quite good to see that the distribution yield, even including pandemic period, which has came down quite a bit. They trade between the 5% to 7%. If you ask me, I think the average, if we take out the exceptional period of pandemic, the industry average is around 6%. Yeah, maybe about 6.5 thereabout most of the time. And then in terms of return, when just now, if you recall the slides which I talk about the capital gain or loss, right? This is where also I would like to share with you, when you look at the return of REIT, it will be affected by price movement, because REIT at the end of the day is still an equity. So don't assume that when you invest in a REIT, you get your dividend, which is the red line, quite stable, and assume that your price or the share price, unit price will not move, which is not true. So when you make investment decision, or when you do your homework, like I mentioned just now, right, it's good to also understand the business, so that this part of it, and you can see this part of it, the movement in the share price can potentially wipe off your the distribution yield. So that's why the total return is the line. The green line is where we should be targeting as an investor to be realistic in our investment. Otherwise, you will be disappointed. At certain years, the investment can turn into negative. For example, in 2018 and 2020, because of 2020 and 2021 were exceptional because of COVID, but 2018 was because of interest rate. So in these slides, I also would like to share with you, if you look at the volatility of a REIT investment, you will observe that REIT tend to be more volatile as well as less performing during rising interest rate cycle. This investment or instrument is quite sensitive to interest rate. So when the market expects interest rate to rise, typically in those years, the performance will be softer. The reason is because the borrowing cost will increase, and that will affect the income. So when borrowing costs increase, our interest costs will increase, and our net income will be lower. The second reason is because from investors' perspective, when you invest in a REIT, right, the distribution is where typically we will compare with our other investment return. For example, if I put my money in EPF, what do I get? If I put my money in FD, what do I get? For the institutional investors like fund managers, they will compare to, if I compare this to 10-year MGS, the Malaysian government bonds, what is the differential? If I invest outside Malaysia, what is the differential? So that's why they are very sensitive to interest rate movement because of these reasons. Okay. On this page, so I would like to share with you from the interest rate element, right? And last year, how did REIT perform? The REIT in Malaysia perform, and also what were the factors that affected their performance? I think the factors were more important than the number itself, because if you see during COVID, REITs in Malaysia, just like any other equities, right, or businesses, were quite impacted by the pandemic, especially retail and as well as those with exposure in hotels, because retail, you know, during the various lockdown, only essential services were allowed to operate. So many of their tenants which are non-essential, even essential which operate, were not doing well. Those non-essential were not allowed to operate. So what most of the REIT manager did for their tenants and their retail malls were paying rental rebate. That means we were giving discount to the rebates to the tenants, and that's where it means essentially the REIT lost their rental and lost income. Secondly, when during the various lockdown as well, there were a lot of containment, like boundaries, right? Containment measures where we cannot go interstate, international tourists could not come in, so hotels were also shut down quite a while. And even if they were not shut down, there were very, very little business. So that was the reason why REIT did not perform, and hence the share price was penalized. So they suffered in terms of share price. In terms of dividend also, they suffer. So the REIT, for the first time in history in Malaysia, in fact, I have never seen that kind of yield before. A REIT, well-performing leading REIT, distribution could came down to as low as 3%. It's really never seen in the history of Malaysia REIT market. And the reason is because when we lost income from the rental, naturally the REIT doesn't have money to pay investor more dividend. So that's where the dividend also came down in tandem. That's why they in 2020, 2021, REITs were quite adversely affected, with the exception of, I think, office REITs were quite stable, because office tenants seem not to suffer as much. So rental rebates given to offices were very negligible. And the industrial ones were the ones which came out very strongly during this period of time, because most industrials were essential services and they were able to continue to operate. And fast forward to 2020, when you look at this, the positive turnaround was after 2 years of negative return, the REIT market turned around with a positive return of averagely at 4.3%. Is this a good number? The real answer is it is not, because this is actually below the distribution yield that you will be getting as an investor, meaning there are quite a number of REITs which were still in the negative territory in terms of the share price. And why is that so? In 2020, it was a very strong rebound for the retail segment, thankfully. Hotel was recovering, but at a very gradual basis, because hotel segment in 2022, most of the time still dependent on domestic travelers, our staycation, our cuti Malaysia, but the real international tourists didn't come back in the whole of 2022. When it came to business section of the hotel business, like the MICE activities, we still have, although we've moved into endemic, but we still have social distancing. And if you recall, we were still in mask most of the time. There were very little social events and social activities that happened in 2022. That's why the hotel business did not recover to the pre-pandemic level in 2022. That also clearly explains why you look at this chart, the REITs have not fully recovered in 2022. Another reason for this is also first time in our history, if we follow theory, when the REITs are performing better, the financial performance are better, theoretically, right, all the REITs should perform much better than COVID level, but it didn't. It's because of interest rate. In 2022, when US raised their rates aggressively, Malaysia also followed. So Malaysia also raised 4 times. And like I mentioned just now, right, interest rate, REITs are very sensitive to interest rates. So in this case, the sentiment for REIT in 2022 was also affected by interest rate environment. In a rising interest rate environment, the REITs are expected not to perform as well. So that's why it was a combination of factors that affected the performance in 2022. Otherwise, I think if it is not because of interest rate environment, I suspect the REITs performance would have been better. So coming to where we are today for the first 3 months, I plotted this up to yesterday's data. So if you look at this, it is good and it is very positive to see that in a short span of 3 months, the average return has increased by 9.2%. And it is also very encouraging to see that the distribution yield expectation in 2023 has still got upside. So what it says here is, it means the market is expecting the REITs to continue to recover. And some of the retail REITs actually have fully recovered to pre-pandemic in 2022. In fact, if I may share some statistics, like retail segment or the retail malls, some of the retail malls, the retail footfall were very strong. The retail sales, meaning the tenant sales, which they have done in 2022, were better than pre-pandemic level. I cannot generalize for all REITs as I represent Sunway, right? So I can share here that for Sunway REIT, for example, we observed that the retail sales were even stronger than pre-pandemic level. So that was very encouraging and very surprising to us when we saw that data throughout the years. So in this year, what are we expecting? We think that retail should continue to be resilient because local, I think we're here, right? We can apply our women's skill in shopping, because the good thing about REIT and what I like about REIT investment, that is something that we relate to our day-to-day life very easily when we do research and try to understand the performance of the REIT. Why do we say that this year should still be a decent year for retail malls? Is because I think domestic spending will remain decent or relatively stable because as long as I think we are comfortable with our job security, our business prospects, this is where we will still be willing to spend decently. So on the domestic side, we think it will be fine. On the international side, this year, we are hopeful that more tourists will come back to Malaysia, especially with the reopening of China, which they have not come back in a big way until today. So this will provide the upside to the business performance in 2023. As well as like, for example, likewise for hotel. Hotel is likely to be continue to improve as well because where last year we didn't fully enjoy the return of tourists, this year we are hopeful that the tourists will bring us the upside for the hotel segment. Then the rest are expected to be stable, like the offices, the industrial in recent years, maybe in the last 3 to 4 years, has been gaining traction and has been gaining interest of investors because I think this is not just pure sentiment, it is backed by real demand that I will share later as well. So there is fundamental reason that support the strong sentiment and demand for retail REITs, for industrial REITs and industrial properties. Okay, just one more element of technicality here before I move on to something more interesting. When we look at REITs, right? So in terms, besides looking at distribution yield, capital appreciation, depreciation, where you can study and then put in, and we'll just move back here, put in your consideration or your evaluation as as a shopper or as a user of the hotel, right? When we patronize. So we always ask ourselves and relate our own experience, shopping experience, to what we like in a mall, what we think is good, or what contributed to the mall to perform well. So this is where you can pick the choice of your investment as well. Just relate to our personal experience. That will help you a lot to do research in a REIT. So in this case, the next element which when we try to understand and try to pick a REIT is also by looking at this chart here. It is called the price to NAV. So what we do is we compare the price of the REIT today and to their latest NAV. So NAV essentially is your value, the book value of the company. It is similar to when you compare to price to book of some of the PLCs, which you research sometimes. In REIT, we don't usually look at PE because PE is not very meaningful in the context of REIT. So REIT, we don't look at PE, we look at price to NAV. So we look at the premium and discount, and you try to relate this to PE. So the higher, the better, or the lower, the better. It depends. Because the higher, sometimes a rich PE of 40 times has some meaning to it. Maybe they are given a premium because of management, because of high growth expectation. Hence, investors are willing to price in very high PE. So likewise, in this case, a high premium to NAV does not necessarily mean it's not good or too expensive. IGB is a very interesting example. It has always traded at very, very high premium to NAV. And in this case, I think one of the premium which investors give them could be the quality of their retail mall, which are both very high quality, and the quality of their performance, financial performance as well. So likewise, Axis, like I said just now, right? I mentioned the industrial REITs are getting better valuation today. Being, for example, you see the premium the Axis REIT receives, an AME, which was just listed, and then also Atrium. Okay, you see Atrium here, from a negative in the past, they are now trading at a positive or a premium already. So these industrial sectors in recent times, they are the hot sectors in the context of REIT. But the improving ones are definitely the retail, as well as some of those with hotel component, depending on your view on hotel performance in the long term. But retail is also doing well. So, so here, essentially, just to share with you, look at, when you look at the REIT, also take some time to understand why sometimes at what level they are trading at, and does negative here, for example, trading at huge discount to NAV is a good thing. This I would like to relate to property counter. Most property counters in the country trades at huge discount to their book value. Does that mean that the property company is not good? It doesn't necessarily mean so, right? So when you look at some of the negatives here, I would advise, do not jump into the gun, as in by looking at steep discount, you think that, oh, there is massive upside potential. It may not be true. It may be because of certain fundamental reason that it is trading at a discount. So if I may just repeat, do your homework, spend some time reading annual report, looking at their businesses before you make any conclusion in your investment. Okay. This part onward is all on the more forward looking, because I think where you will appreciate better is, say I am now an interested investor. I am interested to invest in REIT. What should I be looking at? And how do I do research? When you say do research, right? So I would like to share the next few slides here on what are the things that we could be looking at as an investor, and try to pick which sector or which REIT that we like to invest in. So here you see that the COVID pandemic has changed our lifestyle tremendously, as well as it has created a lot of opportunities for many businesses. It has also, one thing for sure, accelerated the adoption of technology. So where now it is very common that we hear from people, we have hybrid working arrangement, we have flexi working arrangement, we are even allowed to work from home. Our kids are going for online or virtual tuition, no longer physical, and then most of the meetings are done a lot more efficiently through online meetings. Female like us, we like to shop online as well, and I think product delivery is something that knock on our door a lot of times in a day, whether in our offices or at home. So all this, and food delivery as well, all this have become part and parcel of our life. And how does this actually bring in opportunities or threat to the REIT industry is here. And with all this adaptation, right, I will be lying to you that this doesn't have any impact to the businesses. Some of this development definitely will be or are already threats to some of our businesses. For example, a physical retail mall. And then what do we do as a REIT to maintain our business, if not to defend our business, or even you can still grow, but how can we do that? By taking opportunities of some of these new trends. In this case, you will observe that retail mall, we also, in fact, in Sunway, we stop using the word shopping, because we think that consumers today no longer walk into the mall to shop. Although my title is still shop, it is retailing, it is also experiential. So when a consumer walk into the mall today, it is not just to shop or window shop, it is more than that. It is beyond shopping. That's why for physical retail mall to remain relevant, to remain attractive, and to remain the traction, right? Whether it is the footfall that people come in, the traffic people come in, as well as, more importantly, we have to ensure that our tenants flourish. By ensuring our tenant flourish, we believe that experiential retailing is the way to go forward. And in some of this example, for what you can see here, we we need to attract tenants which are destination retail based, because meaning consumer will make effort to patronize the mall because the tenant is there. For example, like I think Don Don Donki has always proven to be one of the attraction that people will make an effort to go there. And then new experiential retail, which I saw very recently in Singapore, it is Hai Di Lao, where you have your hot pot in a snow condition, especially in tropical countries like ours, right? We don't have snow. So these are the experiential retailing that make it different. And for example, leisure as well. I think Pavilion Bukit Jalil just opened its skating ring, and where you can have like a winter snowfall situation, to play with snow in that place. So all this is important because where experiential is something that cannot be replaced by online. When we click and buy through Shopee, we will never get the experience of some of this experiential that you will get in a physical mall. So this is the trend that we're moving forward. And of course, if you look at it, hybrid retail will become a norm, and is becoming a norm. That means tenants are no longer operating in a single platform. They don't choose just physical shopping mall, but most of them will go hybrid. They have both O2O. They will have online, offline, and that will become a norm. And that will become a norm of consumer as well. And in overseas, you even have last mile delivery, where drones sending your products to you, to your home. So these are the new retail trends that a REIT can and should evolve ourselves into this direction, because this is where we will remain competitive, remain attractive to consumer. And when we remain competitive, means we will continue to generate income in order to pay you dividend. Office space as well. Office space has also transformed by itself, because like office is no longer an office. In the case of some places in the region, in Singapore, for example, these are co-working, communal living. You have integrated components of co-working, co-living, as well as many other components, of course, including retail in an office tower. So it is all integrated as part and parcel of our lifestyle. Green building, higher specification is becoming a must, especially with the advancement and fast adoption of ESG, which also I will briefly go through a bit later. So green building, higher specs are a must already. Workspace flexibility, in fact, in some places, offices rooftop also has leisure and also collaborative space for your tenants to socialize, and for like they do employees engagement activities, so they can use this space for all this purpose as well. In the hotel segment, hotel has to continue to refresh themselves, evolve, and also bring in new attraction to not just attract local tourists or customers like us, but they need to be very competitive to fight or to compete against many other competitors in the world, especially in the next few years where people start traveling again. So it's the best time for us to capture those opportunities. I think some trends are lifestyle driven, like thematic suites, luxury retreat, wellness retreat is gaining quite a bit of traction, and then F&B side on gastronomical experience as well. Yeah. So this will be my second last page. Just now when I mentioned about industrial and why industrial is real, because with growing global mega trends, these mega trends will lead to more opportunities for the REITs as well. With the growing affluence of the global population, that we typically will expect better quality education, better healthcare facilities for whether the youngs and the elderly. And also when we come to education, like hostels, nowadays students no longer stays in hostels. They stay in students' accommodations, which well, parents have to pay quite a fair bit for their students' accommodation. So this essentially are opportunities for REITs which they may consider investing in as in their portfolio. The rise of e-commerce, which grown very rapidly, has become a threat to the physical malls, which I mentioned. That's why more have to evolve. However, it also created very large opportunities to the REIT, because with e-commerce, supply chain, procurement, and logistic value chain, right, that leads to a lot more demand for e-commerce warehouses and logistic hubs. So again, REIT, it is an investment opportunity for REITs. This is where the industrial REITs, they would have opportunities, or they would have advantage, because this is a real demand that will continue to grow. Again, if I may just hop a little bit over to this side, in terms of industrial revolution, the growth of manufacturing plants, or maybe depending on the type of supply value that they are in, some of the manufacturing plants can be pretty high-tech and very sizable. And with this, actually, this is exactly where the industrial REITs are having a lot of opportunities for them to grow. And of course, on the other side of things is innovation and digitalization that will create new opportunities, in the sense which I think at this juncture we could think about things like data centers. But going forward, sometimes we will never know what are the even more advanced innovation that will lead to new opportunities for the REITs. One example, which is, I wouldn't say innovative, but they are new investment which has not been invested in any REIT, is in one of my earlier slides, which we talk about cloud kitchen. Cloud kitchen is still small, relatively small in Malaysia. Who knows, one day cloud kitchen would grow to the size of like industrial sizes, that it is investable for a REIT. And with the e-commerce industrial revolution and more plants, as well as advancing ESG in today's context, where ESG has become a very prominent feature for all PLCs, not just REIT, right? It also leads to new opportunities, which I can share here. One example that I could think of from the social pillar, where industrial and also factories, manufacturing plants, especially for the MNCs, they would require a very decent accommodation for their laborers, especially the foreign labor. So in this case, the emergence of new investment for the REIT is what is that called? I lost that's not student accommodation, the dormitory, the CLQ for their laborers. So this is a new investment class which came in just last year when AME got listed. Yeah. So, and beyond that, I think thinking forward, an expansion of ESG, and a very important element of ESG is climate action. You never know, solar farm may be an investment asset of REIT in the future as well. So this global megatrend will continue to create opportunities for REIT to invest in, and this is where we relate this to our normal day-to-day life, or some of our general knowledge. We'll be able to evaluate and to see the prospect of a REIT in their growth opportunities. So last page is outlook at a glance. I think it's also fair to share, let's say if I'm interested to invest in REITs, last year was a good year because the performance were improving very exponentially, especially for the retail mall, because they were at very depressed level. However, interest rate has hampered their recovery or the performance of the REIT. But what about this year? What should we expect? So I actually have I think I have thought of 5 points to share, the plus and the negatives. So in terms of the plus, in Malaysia, it should still be a relatively healthy situation because the economic growth is expected to grow at a still relatively healthy level of 4 to 5%. Of course, it is moderating from last year. That said, the 4 to 5% growth in Malaysia is still relatively decent. In terms of inflationary pressure, it has already showed sign of coming off. So that is a good sign. The pace of interest rate hike is also expected to slow down. If not, it should end by this year, depending on what is happening globally, as well as actually more of what is happening globally, as well as the inflationary pressure, if can be contained. If everything goes well and based on the current signs, we think interest rate hike should stop this year. And then it is also relatively stable consumer sentiment and business confidence because, like I said, I think so long as we are comfortable that we will still have our job, our business remains fine, then consumer sentiment should remain healthy. And the plus point here, which is going to be a bonus to everyone, every REIT, is the reopening of international borders, as last year we did not enjoy the full return of tourists because most of them went to neighboring countries like Singapore and Thailand. So we hope that this year they will start coming to Malaysia, as well as, more importantly, the return of China tourists as well. And on the cautious side, what will slow us down, or what will be not favorable to the performance of REIT, of course, will be reliant on global as well. The global economic slowdown will not only just affect REIT, but it will affect the whole world. And the risk of US going into recession, escalation of geopolitical tension. Actually, when we look at REITs is not highly sensitive to geopolitical or political tension. However, the geopolitical tension has a spillover effect which affected global supply chain. So when global supply chain is affected, it affects the cost part of things and the supply side of things, where sometimes, for example, raw material price would go up, and then tenants may not have their stocks to retail, and that will affect the performance of the REIT. Stubborn inflation, because stubborn inflation, if inflation were to remain high globally, especially in US, then the Fed will continue to increase interest rate. When the Fed continues to increase interest rate, then it will affect the rest of the world as well, because typically most countries will have to follow to a certain extent. So and lastly, which at this juncture, I think economists and market experts are expecting the global bank crisis are manageable and are not going to burst into a global financial crisis. Of course, fingers crossed, I really don't hope that to happen, but this is definitely a risk that we should be looking out for. So with that, my last slide here. After listening to my discussion, right, I hope now when I ask the same question again, shop to invest or invest to shop, and I hope that your answer would be, well, I invest first, and then from the profit that I generate or I gain from my investment, can definitely shop later. So with that, I thank you for your time.
All right. Thank you so much, Crystal, for giving us a very strong, powerful concluding remarks. So now we learned about REITs and how do we evaluate REITs. So if you have any questions for our speaker today, please write them in the Q&A box and we'll address them accordingly.
I see one question from Brandon with regards to development of Sunway Pier. for the benefit of maybe the crowd, Sunway Pier is a property acquired by Sunway REIT for the purpose of redevelopment. The REIT is planning to develop Sunway Pier into a tourist-centric retail destination, and the status of this property now is we are still in the planning stage, because as we said, we would like to ensure that this property is going to be a tourist attraction, whereby just like us driving all the way to Sekinchan for a day trip, that is our aspiration as well, that people will drive there, and we have sufficient attraction to attract them to stay at Sunway Pier for a day trip. So we are still in the planning stage, because we want to ensure that the planning is thoroughly thought after, at a cost that we are comfortable with.
Thank you so much. Yeah. Moses' next question is, what does withholding tax mean?
Okay, it means that when we say a REIT is not subjected to tax, it is at the REIT company level. So let's say that means what you will see is that the PAT and the PBT is the same, so long as the REIT declare at least 90% of our distributable income. But as an investor, when you invest and you receive the dividend or the distribution, right, your distribution will be taxed at 10%.
All right. So in other words, the REITs doesn't have to pay corporate tax, but as individual investors, we are subject to 10% dividend withholding tax, in which you don't have to file it yourself, but it will be automatically deducted when you receive the dividend. So then that means when you receive the dividend, it is net dividend.
Yes. Thank you for the clarification.
Yes, that's right. So if you had more questions for our speaker, Crystal, today, please write them in the Q&A box.
I hope I didn't bore you until you have no questions for me.
I think probably your presentation was just too good that it has covered all corners. I think, Crystal, when the REITs calculate their DPU, distribution per unit, there are some part that is taxable and there are some part that is non-taxable. Could you explain a little bit about that?
Typically, they are non-taxable, but sometimes there are a small portion of taxable is because of certain component, right? Because you see, when we generate the income that we generate it comes from different sources, rental and many other sources, right? And sometimes you have non-rental income, and some of this non-rental income or income that is subjected to a small level of tax. So that's why you will see a very small amount which is taxable. Is usually quite negligible.
Are you familiar with the nature of the business activities that will make a REIT that is Sharia compliant?
Essentially, it is the business that you are in. Usually, the sin element cannot be there.
Riba, the gambling.
Yes, and the other element is entertainment. So, for example, hotel, by definition, has entertainment elements, and hotel, once you have a hotel, you will not be able to apply for Sharia. The third one is on your financing side. Financing side to qualify for Sharia is not challenging. We just need to convert our debt, our financing, right, to Islamic instruments. But usually it's because of the nature of your business.
Okay, how about a retail mall? If I want to keep my retail mall as Sharia compliant, does that mean that I cannot lease out the property to like non-halal restaurants?
There are thresholds. There are thresholds. So for when you get listed for a Sharia counter or Sharia REIT, when a Sharia REIT is listed, typically is 20% from a 20% threshold. But over time, if I remember correctly, should be over a period of 5 years. If you have more than that, you have to bring it down to 5%.
That means 20% of my tenants at most can be non-halal F&B operator.
At point of listing, but after listing, you're supposed to bring it down to 5%.
5%.
If I remember correctly. Likewise, if you have offices, even industrial, your tenants' exposure to non-Sharia cannot be more than the 5%. So that means if you have a bank, if the REIT chooses to be a Sharia REIT, and you have an office block, and the office block has financial institutions, conventional banking, so they are supposed to make a decision not to accept, because if you accept that, right, it will breach your threshold. So sometimes we do say that it can be pretty challenging because of, for business reason, right? You lose income because of the Sharia compliance.
Yeah, I think the selection of tenants become very limited.
Slightly more limited because is your sin, and then the category is not I wouldn't say it's highly restrictive, it's still manageable. You just have to make the choice when that happens.
Okay, thank you so much, Crystal, for the clarification. The next question is by Peter. Do you foresee a further increase in interest rate?
We do see, we think that there should be one more, if not two more at most. But it seems like maximum 1 to 2 more until the end of this year, then it will end. Because I think in a normal economic cycle, if we take aside a real crisis, right? If we take aside economic crisis, when interest rate reaches a certain level, it will start to be a burden to businesses as well to operate, right? Because our costs of doing business would increase. When your cost of doing business increase, then naturally your earnings will also or your earnings growth will also come off, and that's where economic growth theoretically should come down in tandem. Then that's where the balance will be made. When economic growth slows down, I think Bank Negara will not have avenue to increase further, because they would need to be accommodative and support business growth. So that's where we think in normal circumstances it should be, given the fact that inflation is also showing signs of easing and manageable already. Of course, disclaimer is barring any unforeseen circumstances.
Yep. Hopefully the banking crisis can be contained.
Definitely.
Cause a systematic impact to the world.
Yes.
I see a question about from Hao, giving a remark that, but companies' dividends are non-taxable. Now, of course, if you look at it this way, company dividends are non-taxable because the company has already paid tax.
Yes. Right. The tax, of course, if you don't have any allowances like ITA, IBA, a normal company would pay 24% tax.
Yep.
25 for now. Wait, hang on.
24,
now is
I think it should be 24.
25 if you're not wrong. Yeah, they have been taxed.
Yeah, so the company has already paid tax. So as individual shareholders, so we are tax exempt on the dividend they receive. But for the REIT perspective, they are not required to pay tax if they declare more than 90% of their net income as dividend. So as an individual investor, then we are withheld 10% for the dividend they receive.
Of course, maybe just a bit of sharing. Of course, this is one topic that the association, the REIT Managers Association, has been engaging authorities in this context, because in Singapore, retail investors, right, are tax exempted. So they don't pay 10%. Their withholding tax is 0. And that also explains why Singapore REITs market grows so much bigger and attracts so many more investors, because their tax regime is more attractive than ours. So we have been, the association has been in engagement with our authorities, hoping that one day this can also be removed to increase the competitiveness of the REIT industry in Malaysia.
So you're saying that as REIT, don't have to pay corporate tax, and the individual investor don't have to be withheld dividend.
Yeah. They don't need to pay withholding.
So we have to play the catch-up game.
We hope so. We hope so too. Yeah.
So that's why we see more REITs listed in SGX.
Yes, and their investors base are also bigger in Singapore. Yeah.
The next question by PY is, what are the key reasons the rental yield per square feet for Pavilion REIT is so much higher compared to IGB Mall and Sunway Mall?
All right. It is different market segment in general. IGB malls and Sunway malls are quite comparable, because our market segment and our tenants operating performance are also comparable. Our market clientele also comparable, so that's why you see the rental is also comparable. Whereas in the context of Pavilion KLCC, they are more premium. Pavilion KL, I have to specifically say Pavilion KL, and also KLCC, they are definitely more iconic and more premium malls, because you look at the profile of their tenants, they have the top-notch luxury brands, which Sunway doesn't have. In the context of IGB malls, right, the Gardens has some, but not extensive. So ours are more mass market to mid to upper. However, the other two has luxury, and luxury brand sales are also different numbers that compared to the mass market brand. So that's why that explains their higher rental, as well as during the pre-COVID times, their patronage of tourists are also higher. So there are fundamental reasons, because typically when you're a tourist, you come to Malaysia, you go KLCC and Pavilion. So they have higher catchment of tourist market as well, and the luxury segment, which the Sunway REIT and the IGB doesn't have as much.
So these two REITs command better rental.
Yes.
Premium rental.
Yeah.
But I'm guessing that if Pavilion REIT acquire the Pavilion Bukit Jalil, I think their average rental yield will drop a bit.
They wouldn't say the rental yield, but the rental will be different. Yeah, they're different locations. Yeah. Yield may not drop because they get additional income, right? So like you have another new house to rent out. So
yeah, but they probably have to figure out how to come up with the cash to acquire the properties.
They will be doing fundraising
private placement
Yes.
Because you got to manage the debt to asset ratio to a healthy level.
Correct, but they do have debt headrooms also, so I believe they will be able to do it comfortably.
Yep.
Yeah.
The next question is, given the revaluation gains is non-cash, can you show from P&L or cash flow statement how to derive the distributable income from which 90% must be paid?
Oh, we take the realized income only. So it is in the P&L, you will see at the bottom line, right, you will see realized income and non-realized. So revaluation gain is non-realized. What is paid for investors is based on realized income. That's why we say distributable income. It's based on the real money that we have, that we can distribute 90%, because unrealized is a book value.
That's right. So those money that you have received.
Yeah.
Yes. The next question is by Philip. Are our local REIT return comparable with Singapore REIT return generally?
I would say it depends on period, different period, but in general, you will observe that the trading pattern of Singapore REITs are more volatile. Their behavior is more volatile than MREITs. My suspicion is because they have larger pool of international investors. Hence, the movement of liquidity is a lot more robust. Trading activities a lot more robust in Singapore. Secondly, is because the REITs in Singapore are also more active in acquisitions. Their acquisition and disposal activities are a lot more robust compared to a MREITs. In MREITs context, maybe 1 year we will buy one asset. We will acquire one asset. But in the case of Singapore, they can be acquiring a portfolio of assets overseas in a year. So that's where immediately, their ups and the downs in their revenue can be more drastic. So when that happens, naturally, your price also can go up and down in a more drastic manner. So that is what I observe. But overall performance, depending on the time and the REIT, I would think the differential on a normal basis wouldn't be a lot more, but the yield in Singapore could be slightly more most of the time, maybe 1% more. So if okay, less than 1% more, most of the time, let's say we are in the low 6, the average yield of low 6, right? They could be at the high 6. Yeah.
So we are probably between 5 to 6. They could be 6 to 7.
Yeah. Of course, ours, we are talking about average. When you look at the individual REIT, right, then they have different yield. Which just now I did not share. One part is that when we look at yield, just when we talk about PE itself, also we need to be mindful that sometimes high yield doesn't necessarily means that the REIT is performing very well when you do your research, because sometimes high yield is simply because the share price has dropped or the unit price has dropped a lot. So then it's up to you to see whether this is a value buy because the share price has dropped a lot or the unit price has dropped a lot. But if the fundamental is good, then it becomes an opportunity. But if it has dropped a lot because of fundamental reason that the REIT is not performing, then a high yield also doesn't mean that the investment will do well. Not necessarily. Yeah.
The next question is there any difference between asset yield and capitalization rate to measure the more performance?
Asset yield is I assume asset yield is equivalent to NPI yield. We do have 2 levels of yield. Sometimes we talk about NPI yield, which is the yield which we compute based on the net property income. Net property income is revenue minus expenses. That is one yield. The other one, cap rates. Cap rates is usually used by valuers, which they use a more long-term projection and they to derive a cap rate. So that is that will take up like your 10 years projection to derive a cap rate. So this is the main difference. Whereas NPI is more of within that year's NPI. So there's a slight difference in the technicality of things.
But for retail investor, we will just use asset yield.
For retail investors, usually we would use distribution yield, which is your dividend yield, as number one. Then the second level, when you look at annual report and try to study more, right, and just to make sure that the property are performing at decent level, then the asset yield or NPI yield will be also in the annual report. That's where you look at it. The annual report will tell you, say maybe the properties are doing at a yield of 5-6%. They are fine. Yeah, they're doing reasonably well. If they are at 3%, meaning the income is not sufficient.
The next question is, do Sunway retailers share their profit with Sunway REIT?
We do have access to that. They do report their sales numbers.
Do they share that?
They do.
Oh, so
Yes.
there's a fraction of the sales have to go to the REIT lah.
It depends on the tenancy agreement, but majority of our tenants have this clause for a turnover sharing if they hit certain sales number.
How do you ensure that they report this accurately to you?
The safest system is you use a point of sales lah. We call it the POS system.
POS system lah. Okay.
Yeah.
The next question, let's do this one last question before we conclude.
Sure.
If we were to carry out the detailed fundamental analysis on REITs, what are the key numbers or ratio we should be looking at?
Distribution yield, price to NAV, which is either premium or discount. Then the next level that if you want to look into a little bit deeper will be the NPI yield, just now the portfolio yield, to take a deeper look at the individual assets are performing at a healthy level. So these few are quite good enough.
Okay.
Of course, the next level is a little bit of qualitative, is the growth potential. That means because when we invest, we would like to make better return, right? So the growth potential is you look at how active is the REIT in acquisitions, because when the REIT acquires, that's where the REIT can grow their income faster. If you solely rely on rental reversion, which happen maybe every 3 years, right? That growth is organic, we call that. So organic growth is always slower than inorganic when you acquire. So these are the few parameters that we look at. But it doesn't mean that a REIT that doesn't acquire is a bad REIT. So as an investor, we make our choice. If I am happy with a dividend yield of X%, even if that REIT doesn't acquire property, but I'm happy with that return, right? With the distribution yield, that is not a wrong decision or not a wrong investment. However, if I would like to have higher growth than normal, then higher growth and more than distribution yield, then theoretically, I should be looking at REITs that will acquire, because that's where we get extra income.
So these are the qualitative aspect and the quantitative aspect that we can look at when we want to evaluate the REIT and see which one suit our investment objective.
Like I said, in conclusion, we relate this to our personal experience. Actually, REIT is quite easy to evaluate as opposed to some other industry. Let's say you talk about tech companies, right? If I don't know technology, I really cannot pretend that I know how to evaluate the company. But in REIT, because most of the industries are related to our day-to-day life. So if we relate that, we will appreciate the REIT better.
Well said. Thank you so much, Crystal. All right. So, ladies and gentlemen, you just heard from the head of investor relations of Sunway Berhad, Miss Crystal Tay, for doing this segment, Shop and Invest in REIT first. Thank you so much, Crystal.
Thank you, Shane. Thank you, Persa, again, and thank you, everyone. Have a blessed evening. Goodbye.
All right. So for our next webinar, it is titled. It is a Mandarin webinar that's titled 组合重组. So we'll be looking at portfolio reconstructions. If our portfolio happens to have some shakeup or the market have gone against us, how should we reposition or restructure our portfolio so that it can withstand the test of time and consistently grow and compound to the return that we require. So it's happening on the 3rd of April 2023. It's next Monday, 8:30 to 10 p.m. I've just given you the registration link, so you can register for this session if you want to learn how do you restructure your portfolio so that it can withstand the test of time and emerge even stronger. So tune in for the session next Monday, all right? And this is going to be conducted in Mandarin. So with that, I want to thank all of you for tuning in to this session until the very last hour of this session. So thank you everybody for tuning in. Hope that you have gained enormous value from Crystal sharing today. So hope to see you guys on our next Monday webinar. Bye everybody.
Thank you.
Bye, Crystal.
Bye.